Good afternoon, ladies and gentlemen. This is Robert Rayburn here at VLifePro Asset Management. And as usual, I just want to thank everyone for taking time out of their busy schedules to join us for this week's update. Now, you're going to notice the background is a little bit different than usual. Some work is being done over across the way in my office. So we are using our founder's office this week to record the update. Now, we know over the last month or so, there's been a lot of volatility in the market. So I just wanted to take this time to really thank everyone for their patience as we make this big generational shift in the portfolio. Really, for the first time, we've started to see the fruits of that transition start to take place. We're seeing the first signs of the broad market starting to rotate away from those crowded technology positions and toward some of those more economically sensitive areas such as oil and gas, financials, the consumer stocks, and of course, industrials and materials. And so we're going to go through all of that today. The title of this week's update is, which game do you want to play? And the reason why we called our update, which game do you want to play, is, excuse me, over the very, very short term, it's hard to try and time the market, right? Day in, day out, week to week. There's so much noise. There's so many things that may matter to stocks, but a lot of the things, and 95% of the things we hear in the press, mean absolutely nothing to the companies that we own. But the computers care. Here's the thing, the computers are faster than we are. So if we try to time the market over the very short term, we're going to lose every single time. The computers rig the game against investors. So what we have to say to ourselves is, what game can we play where we rig the game against the computers? And that game is being a longer term investor, because the longer we stretch out that time horizon, the more we're able to filter out the noise that hits stocks day to day, that means absolutely nothing to the individual company and their fundamentals. And the more the market and the investment machine that we're all investing in becomes a weighing machine versus a noise machine. And so that's how we navigate these noisy periods, such as over the last 2 to 4 weeks, because it's been rough. But now we're starting to see the market pay attention to higher oil prices, a better economy. And that's really, at the end of the day, what this week's update is all about. The key takeaways are the markets are starting to look past this COVID Delta scare. Inflation does not appear to be transitory. It appears to be quite sticky when we look at some of that wage data, when we look at housing data, the key factors, rental data. When we look at those key factors that tend to be sticky inflation data points, those are rising upward and to the right. Not runaway inflation, but reflation, the signs of a recovering and healthy and robust economic recovery. So what are the areas that we want to invest in this type of environment? Energy, materials, and financials have a tendency to outperform historically when the economy is going through a V-shaped recovery. Now, and that's exactly what this recovery is all about, ladies and gentlemen. When we look at the current recovery and its trajectory, and we overlay it relative to other recoveries, what we see is that this is the strongest recovery since the post-World War II 1949 recovery. In other words, all other recoveries don't match up to the current trajectory of this recovery. You wouldn't know that by listening to the press. You wouldn't know that by listening to the radio. You wouldn't know that by watching TV, but that's the reality. And we have to embrace that if we want to make money over the long term and we want to outperform the market. We have to pay attention to the facts and not pay attention to the rhetoric. Because remember, in the media, fear does sell. Now, over the last month, the 10-year interest rate has come down quite a bit. We are in around that 1.7 to 1.75% mark. We went all the way down to 1.15%. Now, remember, how does the machine work? When 10-year interest rates come down, the machines say that means growth is slowing. Therefore, we want to sell economically sensitive areas. We want to buy defensive areas of the market, in this case, the FANG, so Google, Apple, Netflix, Amazon. People have been stuffing themselves into those stocks as defense. in anticipation of slowing growth. But look what's happened here. The chart here on the left, we see the break-even inflation expectations starting to turn up. That's interesting. I thought growth was starting to slow. But what we see here is as inflation expectations begin to turn upward, historically, they tend to be a leading indicator for what the 10-year interest rate will do in the bond market. And we can see right now, the 10-year interest rate is trying to bottom. So as investors, we go back to our playbook. If interest rates are going up, is it backed by a strong economy? Let's take a look. Real GDP is spiking upward and to the right. Now, of course, this is driven by extremely easy year-over-year comparisons because last year at this time, the economy was shut down. But what we look at is those 2-year average numbers. And what we see is a GDP recovery that is accelerating. We see a recovery that is being driven and backed by heavy consumer spending, which is what this chart here on the right is. That's the real final sales in the subcategory within the GDP reporting index. So when we look at these numbers, what we see is a steep drop off as the economy was shut down and then a steep recovery. Now, the other big thing we need to consider is this number was actually held back by the fact that a lot of companies can't find inventory. So as those inventories catch up, you're going to see GDP actually pick up even further upward and to the right. So we go back to our model, right? So we say, okay, that if inflation expectations are swinging back up and to the right, what is that a leading indicator of? That tends to be a leading indicator of 10-year interest rates. And what do the machines think when the 10-year interest rate is swinging upward and to the right? Well, that equals higher GDP growth. So higher 10-year interest rate, higher GDP growth, higher inflation expectations. What does that mean for asset allocation? When those factors happen, that equals higher GDP, which means you want to own the oil stocks, the bank stocks, metals, industrial, small cap, consumer discretionary stocks. And you want to sell some of those more defensive technology names, healthcare, mega caps, bonds, utilities, consumer staples. Those are the areas that tend to underperform. And that's when we look at all these factors, that's how we've come to the current asset allocation in the portfolio. That's why we're geared toward an economic reopening. We see those expectations swinging upward to the right. We see the retail sales numbers accelerating. It's only a matter of time, because remember, we don't play the short-term game. We don't compete against the computers. We just understand the computer's rules, and then we stretch our time horizon outward so that we can weigh investments versus try to time the very short term. Now, as it relates to COVID, right, we've had a big upsurge in terms of Delta variant cases. But one of the things that we've noticed, and we go into the hard data here across the world in terms of the way the virus is acting and spreading, and one of the things we notice is that in India, the UK, and Indonesia, that pattern was almost identical, a 45 to 50 day cycle in terms of as the virus accelerates and spreads through the society, it tends to peak 50 days after it's first identified. After 50 days, it tends to slope downward. Why is that? We were thinking about that, and one of the likely reasons is that it is so contagious. In other words, unlike the previous versions of COVID, which took a long time to spread throughout society, this particular strain is spreading so rapidly that it also peaks out quite rapidly. Secondly, in the UK, the US, Israel, these other countries that are highly vaccinated, you're getting a strong surge in these case spreads, but then they're hitting a ceiling as they spread into the vaccinated community. And that's where we're seeing the curve flatten, and then we're seeing it drop. So first it dropped, it peaked and dropped in India, then Indonesia, and of course the UK, which we've spoken about quite a few times. Second, we're starting to see that at the state level here in the US. Missouri was the first state to really be impacted by rising Delta variant cases. Missouri is now the first state to report a peak in cases and now a drop. So we think that Missouri is the leading indicator for the rest of the states in the US. We expect that over in the next 10 to 15 days, you're going to see the general trajectory start to peak and then fall downward here in the US if it follows India, Indonesia, the UK, and of course, Missouri at the state level. And it's interesting because you're starting to see these symptoms, mind the pun there, these symptoms play out in the actual stock market. Now, by the way, before we continue going on, we do have a Twitter account that we do provide all these updates on a daily basis that people can definitely follow. It's LPAM Investments on Twitter. Be sure to follow us. We go through all this stuff on a daily basis. It's short, sweet, to the point, little tidbits of the market on a daily basis. But nevertheless, let's continue the presentation here. So in terms of the symptoms, what we see is that copper is beginning to break out. Again, copper, Dr. Copper, is a broad barometer of economic activity. And it's also an economic barometer of China and global growth in particular. And so when we see copper breaking out upward and to the right, like we see here the chart on the right, that is certainly something that gives us pause and say, hey, you know what? This increases our level of confidence in terms of our long-term call of shifting out of technology and into oil and into copper and into iron ore and materials in particular. Then we look at this chart on the left. This chart shows the 10-year interest rate, which is in red, and then we overlay that with the relative performance of copper versus gold. Now, if we were going into a recessionary environment, gold should outperform copper, and you'll see that copper's relative performance should swing downward and match what's the drop in the 10-year interest rate. Because of all these factors taking place, we actually expect this 10-year interest rate to catch back up to the blue line. And then we go back to our playbook. Rising 10-year interest rates equal higher economic growth. Higher economic growth means economically sensitive areas of the market: copper, oil, banks, consumer. That's the playbook we want to use. The oil trend is intact, ladies and gentlemen. So when we look at different asset classes, when we look at different sectors and stocks, we look at two things outside of the fundamentals. We look at long-term trend and short-term momentum. When a stock gets overbought or a sector becomes overbought in a positive trend, you can get deep, painful pullbacks like we've had over the last month. Oil is in a structural and healthy uptrend. Momentum-wise, over the short term, it has pulled back. So we had weakening momentum in an overbought condition. But now what we're seeing is that momentum is reaccelerating back to the upside in a strong structural long-term uptrend. That is healthy. And we're seeing the same thing here on the oil service side. We're overweight oil service relative to exploration and production names within the oil space. Why? They have more earning sensitivity on an oil recovery because of their operating leverage as businesses. And then we look at energy and materials in terms of an overbought or oversold condition. What we see here is both sectors are dramatically oversold. Now remember, our strategies have risen about 10% off the bottom since 2 Mondays ago. So we're 10% off the bottom, and these names are still dramatically oversold. So one of the things that we've been mentioning to a lot of clients and a lot of advisors, and certainly on the weekly update, is that now's the time you want to be long these areas. Now is the time that we expect a steep recovery. And when the recovery happens, it's not going to be 0.5% a day. It's going to be violent. It's going to be violent and to the upside. That's what happened in March of 2020. And we expect the same this time around. And in the credit markets are largely saying what we're seeing, or at least backing up what we're seeing over on the equity side of the tape. And that is energy bonds never blinked, right? So as we had a correction, a healthy correction in energy stocks, the energy bonds basically never flinched. We saw a slight increase in the spreads, but like literally nothing to write home about. So in the credit markets, credit investors, bond investors were snapping up energy bonds while the stocks were experiencing a short-term correction. That's a good thing. It shows that the balance sheets are healthy and are getting a vote of confidence from the credit markets. That's what we want to see. And we see the same thing across the high yield market. Across the entire market, what we see is that the overall assessment of financial or balance sheet risk is contained. Balance sheets continue to improve, right? So those risk barometers are continuing to stay low. The level of implied credit risk is near cycle lows. This is what we want to see. We want to make sure that there are no blockages in the financial artery system of our economy, because that's what caused the 2008 crisis. And then largely speaking, just a quick reminder, why have we rotated away from technology and into energy, materials, the banks, and the consumer stocks? Technology is up 500 to 600% over the last, call it really last 10 to 11 years. Every decade, we see a broad rotation from one dominant theme to another. It's called a leadership change. And we believe that is, based on our work, that is what's starting to take place in the market. For over 10 years, we've been dramatically overweight technology. For those clients that have been with us for a while, you'll know we were up 101% last year, not because of energy, not because of the banks, but because of technology. We've began that rotation and largely completed that rotation into themes that we think are going to have the next 2, 3, 4, 5 year run. And then we'll assess after that. But that's what we think the dominant trends will be over the next few years. These are areas of the market that have not participated in the bull market over the last 10 years and where the pent-up value is right now. So in other words, we're going from those expensive bubble-like areas of the market, such as technology, which, by the way, those price to sales valuation ratios are higher than the dot-com bubble era. So we're selling at a high, and we're rotating that money into the cheaper areas of the market that have identifiable catalysts to unlock value over the next 6, 12, and 18 months and beyond. So overall, the economic recovery is strong and it's sustainable, and it's one of the best recoveries we've seen since post-World War II. The Delta variant is spreading, but it's not impacting the economy, and that's the key. And secondly, we expect that to peak out here in the next few, and really the next week or so, and that should continue this rotation away from defensive technology and toward the economically sensitive areas of the market, which is where we are invested in. So as usual, I just want to thank everyone for their time, for their patience as we've made this transition and the volatility that has ensued. But I think, after seeing the last 2 weeks, I think that we're on the right path. And certainly we see a lot of things that are working at the fundamental level, whether it's, a lot of these energy companies reporting solid numbers, whether it's the auto stocks reporting great numbers. I think you're seeing at the company level that the recovery is strong and it's accelerating. We're certainly excited to see what the next 6 months bring. So if anyone has any questions, please feel free to reach out to your advisor, reach out to our office at 888-543-3776. And of course, you can reach out to myself as well. Thank you again for your business, your time, and have an absolutely fantastic weekend. Thank you.